All right, guys, so let's start our partnership question, which is question number 4. Oh, no, sorry, I think it's question number 5, isn't it? I think it's question number 5. Okay. Yep. Okay, let's start this one. So question number 5, part A, is about a formation journal. So it says Brent and Lynn formed a partnership by combining their sole trader businesses. You're given fair values and carrying amounts of the assets contributed by each partner and the liabilities assumed by the partnership are as follows. Okay. Now, when it comes to a formation journal, the trick is always use the fair value for assets. Very important. Always use the fair value. So you can ignore accumulated depreciation. You don't need to worry about this. You don't need to worry about these carrying amounts. Always use the fair value. Always use the fair value. Always use the fair value. Okay, now we do separate formation journal entries for each partner. Brent, we start with Brent first. Okay, Brent, you debit Brent's cash at bank, use the fair value, which is 160. Again, for cash at bank, carrying amount equals to the fair value anyway. So you debit cash at bank, 160. Debit accounts receivable, use the fair value, 90. Debit inventory, again, use the fair value, which is 440. Debit building, use the fair value, which is 600,000. Okay, just check whether Brent has any accounts payable. Now, Brent does not have any accounts payable. However, Brent has a mortgage loan, which is 390. 390. Okay. Now, how do you work out Brent's capital? So what you do is you take the sum of Brent's assets, 600, 440, 90 plus 160. So that gives you how much? 600. 1.2 million, 1.29, you minus 390,000, that gives you a capital balance of 900,000. Next, let's prepare a formation journal for Lynn. Okay, fair value of Lynn's cash. Well, cash at bank is 360 for Lynn. Used debit cash at bank 360. Accounts receivable, always use the fair value 230. Inventory 700, that's a fair value. Land, okay, the fair value of Lynn's land is 600,000. Accounts payable is 90. Difference between total assets and total liabilities is 1.8 million. There you go. That's capital, which is credited. All right, guys, let's move on to part B. Now, part B is about profit distribution. Okay. Now, say for example, now before we start with the profit distribution, say you're given Sam and Nat. So if Sam and Nat shares profit in the ratio of say 7:3, which means 70% of profits is assigned to Sam, 30% is assigned to Nat. If Sam and Nat shares profit equally, then Sam gets 50%, Nat gets 50%. If Sam and Nat shares profits in the ratio of 6:4, Sam gets 60 and Nat gets 40. Now here you have 3 partners, so profits are shared in the ratio of 5:3:2, which means 50% of remaining profits is assigned to Sam, 30% is assigned to Nat, and 20% is assigned to Sean. Okay. Now, guys, when it comes to salaries are paid out of partnership profits. When a partnership makes a profit, it pays salaries to partners who work for the partnership. So Sam received 50,000, Nat received 30, and Sean received 40. Partners also receive interest. Now in this question, interest rate is 10% on their beginning capital. You can ignore this. You don't need this. Okay, you don't need this. So interest is assigned on partners' opening capital balances. These are the opening capital balances. Okay, you can ignore drawings when it comes to profit distribution. Now, partnership made a profit of 340,000. Okay, Sam, Nat, Sean. In the exam, you need to fill this out. Okay, salary. How much salaries did they receive? Sam received 50,000, Nat received 30, and Sean received 40. So total salaries paid by the partnership is 120. Interest. Sam received, partnership pays 10% interest on their opening capital balances. Sam's opening capital balance is 100,000. So you see here, 10,000. And Nat's opening capital balance is 60. And Nat received $6,000 interest. Sean's opening capital balance is 40. Sean received $4,000 interest. So partnership paid $20,000 of interest. So you see here. So guys, what's the remaining profit then? Okay, partnership made a profit of 340,000. You minus salaries 120. You also minus interest, which is 20. That gives you a total of 140. That's how you get $200,000 of remaining profit. So how much does Sam receive? Sam receives 50% of that. That is 100. That's 100,000. Nat receives 30% of that. That is 60,000. And Sean receives 20% of remaining profits. That is 40,000. Okay, so total profits received by the partners. Sam received 50,000, 10,000, 100,000, 160,000. Nat received 30,000, 6,000, 60,000, 96,000. Sean received 40,000, 4,000, and 40,000, 84,000. Alright guys, so part 1 asks us to use method 1. First, we need to close partnership profits to profit distribution. So you debit profit and loss summary, credit profit distribution for 340,000. And then under method 1, profits are transferred from profit distribution to partners capital account. So you debit profit distribution, credit capital Sam 160. Credit capital Nat 96 and credit capital Sean 84. Okay, and partners also made drawings, so we are asked to record drawings and close drawings. So drawings Nat $10,000 from profits and Sean $12,000 from profits. So how do you record drawings? So we debit drawings, credit cash at bank for Nat. For Sean, debit drawings, credit cash at bank. Guys, under method 1, drawings are close to capital. So you debit capital and you credit drawings. That's for Nat. For Sean, again, debit capital Sean and credit drawings Sean. 12,000. Okay, let's start method 2. Under method 2 again, profit distribution is the same. First we close profits, partnership profits to profit distribution, debit P&L summary, credit profit distribution, and then profits are transferred to partners retained earnings account under method 2. We use method 2 here. Under method 2, profits are transferred from profit distribution to partners retained earnings. There you go. Debit profit distribution, credit retained earnings. There you go. Okay, again we record drawings. You debit drawings, credit cash at bank. Debit drawing Sean, credit cash at bank 12. And then we close drawings to retain earnings or retain profits under method 2. So you debit retain earnings, credit drawings. debit retained earnings, credit drawings shown. All right, guys, so there you go. That is partnerships. I'll move on to the next video and I'll cover companies soon. Thanks.